when we get into property strategies, it's more about, I guess, the overall strategy of what that property is there to execute on. What I mean by that is the traditional buy and hold where we focus on capital growth. The other one is the renovate, flip. The other one, the positive neutral cash flow properties, commercial property, and things like NDIS, Airbnb homes, student accommodation, rooming houses, etc. So Mark, it'd be good to get your insight too in terms of what problems we might run in from the lending side.
From what I've read, it's the worst performing asset for the last 50 years in Australia. I've seen some of my customers who have bought under a buyer's advocate's advice and they're stuck holding the asset that was guaranteed to get rent of 160 grand a year and now they can't get 50 grand a year.
For every client that I've dealt with that has had a really successful share or a rooming house and they're making a lot of money off it, I'd probably say the ratio is around about. I've had some where they had such a bad experience, it actually put them off property investing for 10 years.
This client of mine spent $2 million on a build. And just because you spend $2 million on the build doesn't mean it's worth 2.5 of the land, okay? It came in at 1.1.
Welcome back to the No BS Property Investing Podcast. Today, we're talking property strategy. And here's the thing. Most people rush out to buy property without ever asking, what's my strategy? That's why so many investors get stuck or disappointed. So today, we're going to break down the main strategies in property investing, the pros, the cons, when they might apply, and at the end, I'll share what we focus on and why. I'll also be bringing in Mark to give us financial perspective along the way, how the banks see these strategies and what you need to be aware of from the money side. So let's get into it. Mark, welcome back. Good to have you again, mate.
Thanks, Julian, for having me.
Not a problem at all. Now, I guess one thing we talk about when we get into property strategies, it's more about, I guess, the type of properties we're going to be chasing. And I'm not talking about whether it's an apartment or whether it's a home. It's more about, I guess, the overall strategy of what that property is there to execute on. There's lots of different models, right? So, and I guess what I mean by that is the traditional buy and hold where we focus on capital growth and we might be okay with taking on negative gearing, understanding that leverage is going to offset that. The other one is the renovate, flip, where things like the block have really kind of brought that back in vogue over the years, where it's you buy a tired property, you make it up, put lipstick on the pig, and you put it onto the market to make a bit of profit. The other one, which has probably been more of a more recent focus in recent decades, which is the positive neutral cash flow properties, where we almost disregard the growth it makes and we just go out there and we just chase purely positive cash flow or neutral gearing on a property. We'll touch on commercial property and then also the specialist approach. So that might be things like NDIS, Airbnb homes, student accommodation, rooming houses, etc. So Mark, I'm going to ask you about some of them and I'll definitely give it my opinions on them or I guess things that I've seen from a property strategy point of view, having worked with over 1,000 clients over the years, and be good to get your insight too in terms of maybe whether you've had firsthand experiences or clients or even what problems we might run in from the lending side. Does that sound good?
Yeah, it sounds good. Absolutely.
Well, let's go. I'm going to go reverse order, and I guess probably more of the things that are popping up lately. So that's the specialist type of approaches, and what I mean by that, for people are following along. So that's NDIS homes, so on the National Disability Scheme, student accommodation or share homes. So if you're not familiar with what they are, that's somebody who's either built a home bespoke to maybe be a 5-bedroom, 5-bathroom type home where you've got 5 different individuals all living in their own in space, and then they've got a common area to share properties with, or they're doing conversions on properties. So they buy an established home and then they, spend a bit of money and I guess get that up there. Before I get into the negatives and pros on that, I guess maybe from the lending side, Mark, or things that you've seen, like, do you have any positive or negative things to just share on those type of properties?
Customers going down that path, Julian, it's normally yield-based transactions where they're chasing rental yield. And the reason behind that is they're trying to get their income up to get further borrowing capacity. So it's normally people with lower incomes or reach their maximum borrowing capacity. They're looking at ways around that, like with student accommodation, NDIS, et cetera, which can be risky. I mean, NDIS rules just changed significantly a lot in the last few months. And I've seen some of my customers who have bought them not under our advice or under a buyer's advocate's advice, and they're stuck holding the asset that was guaranteed to get rent of 160 grand a year and now they can't get 50 grand a year. So it's normally the people chasing rental yield to increase borrowing capacity to allow them to borrow more to keep their investment strategy, to pursue their investment strategy further. So that's probably what we see a lot from the lending perspective.
Yeah. And I guess from my side of things, what I see with clients, and it's really, and I'm going to talk in very general terms, because I do like to talk when we talk about property, that we talk about in general terms, because what I don't like to highlight too much for people listening is just the outliers. Like, we can go out there and talk about, someone can come in here and talk about how they've invested in apartments and they've made a killing. When the reality is I could pull 100 others who've invested in apartments and they've barely seen anything or lost money. So I think it's really important we keep everything rather generalized without going too niche. I think you're right. My experience with the clients that go down this pathway, it's normally a cash flow concern. They're wanting to get these properties that either make them money or they cover their own expenses along the way, but they probably aren't fully aware of the risks that they potentially expose themselves to. I don't know if you feel that as well, Mark, but if we go into the NDIS, a lot of them are house and land package type setup. So it's not like they're buying an established property and then kitting out the home to be that, which they can go down that pathway. And I'd probably say if you are going to go down that pathway, that's the avenue I probably would be more likely to take than buy the house and land package. Because what we've seen, I think there was a Four Corners report that came out on this a few weeks back, is that they've built all these NDIS homes because the builders are great. If there's a government grant out there, builders are very good, very savvy in terms of trying to cash in on these type of grants and I guess investor interest. But these homes, they're being built on the outskirts of these towns where that's not where the infrastructure is, right? That's where people want to live. They want to live where the infrastructure is. So now they've got these homes where it's really bespoke to a certain individual, right? We've got to understand it. It's a great scheme, like we're trying to help people out in the community, but they also want to live just like us. They want to live where the schools are, where the shopping centres are, where the train lines are, whatever it might be. So they're not able to actually attract these tenants, and they're not then in turn getting these crazy returns in terms of the rent that they're being promised. And I guess the other thing to understand, and I don't know if you see this much on the bank side as well, is you're normally buying a property that's going to be at a negative equity position. If you're going to go build a really bespoke home that's got the 1 or 2 meter doorways and the bespoke kitchen, you're paying more than what that property is worth in the local area. So it might cost you $800,000 or $900,000 to build this bespoke NDIS home in Ballarat. But the $900,000 home in Ballarat is a really great home in a great location in and around Ballarat Central. Do you see that much, Mark, from the lending side?
So you normally, in those cases, they're overpaying, and we see a lot of that. Okay, so it's very, like I said, it's yield based. So if the rental yield and the income side of it doesn't work, there's massive risk there because the growth's not normally there. I'll say not normally because it could be there, but it's not normally there.
Yeah.
And especially not normally there if you've overpaid and paid premiums to get a certain product built. So it's so reliant on the rental side that if that doesn't work out, that's when these people get into trouble. And we do see quite a bit of that.
Yeah. And I think the one thing that a lot of people aren't aware of, like when the bank comes in, and you can maybe touch on this more, Mark, like if their valuer comes in and they need to see comparables, right? They're not really going through these homes and going, oh, great, you've got a unique modified kitchen. That's great. I understand you've paid more. They're going, no, I want to see the comparables in the area that stack up to make this property worth that. And if they don't have them there, which in most cases they don't because you built a really unique home, you're going to really struggle on getting that, maybe that evaluation piece that you're looking for and taking out equity later on. So I think it's a big risk. And then I think the other thing is just trying to understand, like you mentioned, what is that asset for? If you're thinking it's going to be this unicorn property where it's going to be super high cash flow and super high capital growth, it's probably not going to be that. You might get the cash flow. That's probably a maybe, but that's what you're chasing, right? You're chasing the cash flow. Don't go into it, I guess, with growth in mind is probably more. You can still happen. There'll be some unique circumstances, but I think it's going to be more of a cash flow play.
Exactly right. So on the valuation piece, that's a critical part in lending. It's probably the most dangerous part of lending. So if you're buying something that hasn't been built yet, you're putting a deposit down. It's off the plan. You bought it for a certain price, but what's it going to get valued at? Okay, so I'll give you a classic example. 10, 15 years ago in Craigieburn, I think the best house, most expensive place in Craigieburn was $900,000. This client of mine spent $2 million on a build. And just because you spend $2 million on the build doesn't mean it's worth 2.5 with the land. Okay, it came in at 1.1. Okay, so the valuations are done in a way that they're going to value it to something that's comparable in the area. Now, to find a $2.5 million house in Craigieburn, you had to go 40 k's away. Okay, and that was a completely different asset class, so they couldn't even compare that. So they valued at 1.1. So same off the plan with construction and apartments and all these types of things. Who knows what it's going to be valued at in 2 or 3 or 4 years? Who knows what a house that you go and do a specific kitchen for NDIS or bathroom or ramps or whatever you need to do to get it to fit within the guidelines, what that's going to be valued at. And that's where we find, from a lending perspective, We can get the funding for them. It makes sense, but is it the right decision or right strategy? Because in some cases, we can't even fulfill the transaction because the value comes back at a much lower level.
Yeah. And then I guess to add on to that, and this also, I guess, fits with house and land package type homes as well. What you don't know is when you're building that property in this new area, you're not really sure yet what type of area that is that you're buying.
Yeah.
And what I mean by that is, what is that street profile? Is it all owner occupiers, or did the street get filled with other investors and then it's going to become a bit of a slumlord street later on in future years? It's really hard. So because in Australia, we hold property for around about 14 years, pretty much one of the longest in the developed countries in the world. So when we buy an established property, we know the type of suburb that we're buying in, right? It doesn't really change. People aren't selling their properties from week to week. It's a long hold. So it's really important. But then,
and the other side of that, Julian, I'll just add that off the plan also, the developers normally strip most of the value out of it. So you probably know this analytic more than me, but from what I've read, off the plan is the worst performing asset for the last 50 years in Australia. So because the simple reason is the value's been stripped out early. And if the value's been stripped out early, how can you be sure it's going to value up? And then also the second part of that is, as far as the growth potential on that asset, if it's been stripped out earlier, the growth potential is going to take a lot longer, if at all.
Absolutely. And I'll definitely be touching on that growth piece from the builder side as we go through some of these other strategies. And I guess some of the other things that touched on in this specialist approach is like, things like your share homes, your student accommodation, your rooming houses. Before I give my, I guess, pros and cons that I've seen from the investor side, like what are some things that from the lending piece that people need to be aware of? If you're serious about building wealth through property, you don't just need a loan, you need a strategy. And that's exactly what the Australian Lending and Investment Centre delivers, Australia's most awarded brokerage. They're not just looking at what you can borrow, they'll build you a holistic lending plan tailored to your long-term goals. We use them, we trust them, and so do our clients. So to find out more or to book your complimentary lending strategy session, head to the link in the show notes to connect with the team. Thanks for listening. Now back to the video.
So on shared homes, it's not a standard residential property. So if we send a valuer out there, or a bank sends a valuer out there to value the property and they see it's shared and they see multiple kitchens or walls, etc., all of a sudden it becomes a commercial type transaction. It's not a consumer transaction, it's a commercial. It's a transaction to make money. So that fits now under a commercial space. So then the bank will look at it very differently. It will be different rates, different products, different fees, a different assessment. So it doesn't fit under the criteria that you would go to buy a standard residential property.
Does that mean high deposits? Because I guess the common theme out there is, you get a commercial property and you need a 20 or 30% deposit depending on the lender. Is that the same for some of these type of assets?
Absolutely. If you're buying one that's established, absolutely. But what a lot of people do, Julian, is actually go and buy a place and then do a renovation on it and get it through under residential. And then they might do the amendments to the property. But the problem that comes with that is you can't go and revalue that property. So if that property goes up over time and you want to realise the equity out of that property to do other investing, you can't do it because the bank sends a valuer out there, they send them away, they go out there and say there's 8 people living in this place, there's 8 bathrooms, there's 8 walls, there's 8 communal kitchen or whatever, and then they say we can't do the valuation, the bank requests the commercial value to go out there, and then it's assessed as a commercial transaction, as a business, and then that's a lot more expensive, like a $2,000 or $3,000 fee for a valuation, and then it's assessed differently, and then all of a sudden the department within the bank can't deal with it because it now sits in the commercial space. So then rates go up, fees go up, etc. And then the last bit to that people come across is it's very hard to leverage off a commercial property unless you're buying another commercial property. So if you want to buy a residential property, you can't actually leverage back off a commercial property, which is interesting, where a lot of people find issues within the bank system. So you get stuck on this process where it's now under commercial, you can't get access to equity, you can't buy another residential property, but you can only buy another commercial property to leverage off that one that's now assessed as commercial, even though it's zoned residential.
That's that's a bit of an eye opener, that one, because I think people are seeing some of these type of homes were great. I'm going to get the value of it. It's going to increase. I'm going to tap into the equity. I'm going to tap into the cash flow again. Bang, found another unicorn. It sounds like that's not going to be the case as I get further down the line. And I guess the things that I see when you're going down this pathway, for every client that I've dealt with that has had a really successful share or a rooming house and they're making a lot of money off it, I'd probably say the ratio is around about 10 to 1 where they've had a not so great experience. Now, obviously, of those 9 or 10 that are having a bad time, how bad it is different. I'd probably say you get some where I've had some where they had such a bad experience, it actually put them off property investing for 10 years, right? Because it was just a nightmare for them. Then I guess what you've got to understand is, your occupancy rate is not going to be like a traditional established property, right? If you've got 5, 6, 7 tenants sharing that house, you're not going to be having 100% occupancy rate all the time. You're going to be, because I guess it's understanding in general, and again, I'm speaking very generalized in today's podcast, is that you're not going to be attracting high caliber tenants in general. You're not going to be getting your doctors, your lawyers, your working professionals, your working families who are going to stay there for a long period of time. You're either going to be getting people that are transitioning, different stages of work, career, relationship breakups, and they're just somewhere to stay, get their own space. It's going to be kind of a bit of a revolving door, and it can become a bit of a business to manage in itself, right? All of a sudden, you thought you bought this investment that's going to make you a lot of money and in terms of cash flow and growth, but then also too, most people get into property investing because they see it as a passive way to invest their money. That's not the way typically to go about it. And that applies sometimes too for things like Airbnb, where it's like, yeah, great, you've got to pay the cleaner and the servicing fee and the extra maintenance and the wear and tear. So it's, I guess, like I said, you can make money, but don't go into it expecting that it's going to be a hands-off.
It's definitely time-consuming, okay, and a lot more time-consuming than what people think, and a lot more effort. And the people that we put into these types of property structures are people that are normally quite established, quite wealthy, looking at probably a yield play, don't necessarily have to go for the growth, but would like some. I see some of the share accommodation properties that pull 160 grand a year, but the expenses are 130.
Yeah.
By the time you add in interest and rates and cleaning and maintenance and all the different fees you've got to pay for that type of property. So it might only be cash flow possibly 15 or 20 grand.
For a lot of work, right? Because I guess what other people don't understand is you got to furnish this thing. You've got to, if you want to attract high quality tenants, you've got to offer high speed internet. You're paying for the gas, the water, electricity. It's very hard. You can't really split these up. It's kind of inbuilt into the price you charge. So, and then
normally seems better. Normally seems better than what it is.
Yeah.
Okay.
Yeah.
And normally that is the case when you dig a little bit deeper.
Yeah. Yeah, absolutely. I guess it's pretty obvious, from what we're talking about here. We're not really big advocates ourselves on these type of assets, but again, they can work, but in our experience, hasn't always been a great match for the investor profile. The next one I want to get into is commercial property. So that's things like shops, offices, warehouses. I guess the big draw here is that people are chasing higher yields, particularly net yields, because what a lot of people aren't aware of, obviously not for all commercial properties, but in general in commercial properties, sometimes the tenant is liable for all the outgoings or a majority of the outgoings as well. So what's attractive to the investor is I'm getting higher rental yields. I don't have to deal with all these utility bills and some of the maintenance items. Not all of them, depends on the type of one. But I guess from your side, what are some of the big differences that people need to be aware of when it comes to commercial property from the lending piece?
Well, you're going to pay higher rates. Okay, it's normally shorter loan terms as well, not always to start with, but they won't do interest only continuously after 5, 10, 15 years type thing. So you do have to start paying it off. So the payments are normally higher, the rates are higher. The fees can, as you mentioned, a lot of the costs can get covered by the tenant, and that's the attractive thing to people, okay? But the bit I don't like about the commercial side, and yet we still do commercial lending, is that there's not an exit strategy, it's normally a longer term play.
Yeah.
So I don't like it that we can't get out of it. We don't roll it over after 4, 5, 6, 7 years to reduce non-deductible debt and get clients into a better financial situation. Normally, a strategy a lot of our clients will go into after they've paid their house off, they are looking at diversification and they are looking at longer term assets they don't want to sell for 10, 15 years, which is kind of like a yield play.
Yeah.
Yeah. It's a guaranteed yield play. It is going to go up. It's not necessarily something we're going to sell in 5 years. Does it go up in 2 years or 3 years? It doesn't really matter. It's a 15-year term. So it's a very different acquisition to a residential play.
Yeah. And I would agree with that. I actually am, in general, an advocate of it for clients, but it's at the right stage. I think most people, the person at Susan, I guess, probably touching firstly on the growth, where, again, I like to look at longer term periods of play. So in general, over the last kind of 10 to 15 years, commercial properties perform really strongly in terms of capital growth plays. We zoom out of that smaller little spike. It wasn't always really seen as a capital growth market to invest. It was always an investment where you got really, really strong yields. Now, what's kind of happened over the last decade or so is that you've seen the prices skyrocket, and a bit of that has been I guess, off the back of the need, in terms of we're a growing population. People need warehouses, they need shops, they need offices, they need all these things. And there hasn't really probably been the supply side. But also, too, what's happened is, so the prices went up, but then also the yields have come down. So now we're talking about net yields in a lot of these assets, 4 to 6%. So it's not like they're generating crazy cash flow returns. What I would say is I'm a big advocate of it for clients later on when they've built up a lot of capital in their residential space and they're more, or in their super balance. It's great for super as well in terms of, replacing.
I was about to say that, Julian. We're doing a lot of commercial purchases through the superannuation because it is a longer term play. It's not an exit thing, and you're not using the sale proceeds from a super fund to clear your home loan debt. You can't do that.
Yeah.
So it's basically the longer term play. So, but if you're also borrowing at say 65% in the commercial property in the super fund and the yields at say 5%, it's costing nothing to run. So it's sit and forget. So it's probably more suited in most cases to clients in the SMSF space.
Yeah, so definitely for me, it's in the SMSF space, but again, probably more when you've built up a fair bit of money in your super fund because, again, I'm a big advocate if you're getting in the commercial space. It's understanding, kind of like when you're buying property, right? If you're going to go buy a $300,000 asset, you're probably forced to look at an apartment, right? Which we're not really huge advocates for. But if you're buying a $500,000, $700,000 asset, we can get you into really high-performing residential properties that are going to grow at a really great clip. On the commercial property set, if you're going at the lower end, you're going to be buying startup businesses. You're going to be buying into small office spaces or lease spaces for warehouses, etc.
Yeah.
And you're going to be attracting a tenant who's probably starting out. Maybe they're not going to be there in a few years. Maybe they're going to outgrow you. I'm more of a bigger advocate. You'd be coming in when you've got a sizable amount of capital behind you, whether it's in your personal name or through your super. So you can be getting, a really secure tenant. They're on long-term leases. Maybe they've spent $500,000 or $1 million actually fitting out the actual shop that they're in. They're tethered to that site. There might be a multi-state or a multinational business or things like whole shopping complexes where you might have all these different tenants in there and you've reduced your risk, but again, you've got longer term. So I think it's just understanding where it is. Again, an advocate.
Julian, what amounts are you thinking about going into? So for your customers coming to you on the SMSF space, what's the minimum amount you think that they should enter?
At least $1 million. Nothing really under that in general. Maybe you can get a little bit under that, but I think under that, you're not really getting. And then we're talking about from a lending piece, what do we need, Mark, if you want to buy $1 million property?
Yeah, so good one. So if you got 65% of that, you need $350K. Your cost to buy that million assets probably 60, probably 80K with the buyer's advocate type thing. So you're needing 450, you need another 100 odd K in the super to actually run the super fund. So you probably need about 650 in the fund to actually even think about going down a path at $1 million.
Yeah, and that's why I say it's great for people later on in super. It might not be at the beginning when they've only got a couple 100,000 in there. If they're 50, there's two of them maybe. But it's a great one to replace your income. So if you've built up $3 million in your residential fund, and then later on you park that into commercial property, it's netting you, say, a 6% return. Great. You've now got something that's giving you a net return of 6%. You've got $180,000 income to carry you through.
Yep.
That's probably when it makes the most play. But for most people, I think it's that delayed gratification. The bigger you can make that nest egg of capital, you can get the better commercial property later on, and then you can replace income. It's about, we're big advocates at Mark, reducing debt first, then working to building up capital next, and then working towards replacing income. Wow, guys, just jumping in here, it's been a massive episode in today's one where we're talking about property strategies, and there's been so much in there that we've unpacked that we didn't really want to cut out. So what we've done is we've split this up over 2 episodes. So really appreciate everybody listening in. So this is part 1 that you've listened to today, and highly advise you listen to the second one because it's been an absolute can of worms that we've opened where we've covered off all the strategies today. So thanks for listening, and we'll catch you on episode number 2 as well.